Welcome to the deep dive. Today we're digging into a really complex stack of sources. We've got IMF forecasts, some deep analysis from Chatham House, creative planning, and they all paint this picture of the global economy in 2026.
Right.
And if you just look at the headlines, everything seems fine. Global growth is stable, inflation is cooling off.
It looks calm on the surface.
Exactly. But our mission here is to cut through that surface noise and really find the deep underlying, well, the sources call them tectonic tensions that could just upend everything.
And we're not just looking for any old risks. We're looking for systemic threats.
Yeah.
The argument from our sources is that we're entering a period that's really defined by a double bubble.
A double bubble.
So the goal of this deep dive is to analyze the macro environment that allowed these two massive risks to develop at the same time. On one hand, you have the U.S. financial and tech bubble, and on the other, these quiet pressures from China and, of course, global debt.
Okay, let's unpack that definition of bubble right away. Because when we say that, the sources are being very specific. It's not just, stocks are expensive.
That is the crucial distinction. A real systemic bubble, the kind that can take down the whole system, it has four ingredients.
Okay.
First, asset prices are just completely detached from fundamentals. No relation to actual earnings or cash flow. Second, there's extremely high leverage being used to buy those assets.
Right.
And third, you have crowded trades. I mean, basically all the institutional money, all the retail investors are facing the exact same direction.
And I'm guessing the fourth one is the most terrifying part.
Absolutely. The fourth component is just sheer size.
Yeah.
The asset class has to be so enormous that if it collapses, it's big enough to paralyze the entire banking system or the real economy.
And the sources are saying.
They're unanimous. The U.S. equity market, and specifically the tech sector, now meets that definition.
That really sets the stakes incredibly high. So let's zoom out. Let's look at the macro foundation this whole thing is built on. Our sources describe the 2026 environment as being fundamentally asymmetric.
The stability it's really a mirage. Global GDP growth looks okay. It's predicted to be around 2.8% to 3.0%. That's from Goldman Sachs and the IMF. But that number is the sum of two completely different stories.
And on one side of that story, you've got the U.S. engine. The course is called U.S. growth sturdy, right? Expected to hit 2.6%.
Yeah, and it's the story of heavy tech investment, some tax cuts, deregulation. It looks pretty robust on paper.
But there's a catch.
There is. And it's the critical asymmetry. Because that growth is so concentrated in these high capital, automated, tech-intensive sectors, the lender market, for most people, it's starting to show some pretty severe cracks.
So the benefits aren't spreading out.
Not at all. And then you contrast that with China, and the imbalance just gets even starker. They're targeting, 4.5% to 5% growth?
Right. But the way they're getting that growth is totally changed.
It's a crisis of domestic demand. Chinese consumers just are not spending. So to hit their targets, the government is just aggressively ramping up manufacturing exports. They're flooding global markets.
And that's where the trade tensions come from.
That's it. Huge tensions with the U.S. and Europe. And that political risk is now a major factor in the models.
So different economies running on different fuels, that leads directly to this divergence in monetary policy, which feels like the next big asymmetry we need to get our heads around.
Yeah, the central banks are basically pulling in opposite directions. You've got the Federal Reserve, which is expected to continue its easing cycle, bringing its benchmark rate down.
Trying to land the plane softly.
Exactly. Aiming for maybe 3.0% to 3.25%. They want to support growth, avoid a recession after that period of tight money.
But the People's Bank of China, the PBOC, they're stuck. It sounds like an incredibly painful dilemma.
It is agonizing for them. China is fighting deflation, which means they should be cutting rates aggressively to get people to borrow.
But they can't.
They can't. Because if they cut too deeply, you get massive capital outflow money just flees the country looking for a better return, and it would crush the yuan. So they're basically paralyzed.
And this is all happening while the system's just awash with money, right? The Fed has supplied all this liquidity, but it's not actually translating into real economic activity.
That's where that old economic saying comes in, the one from the sources, you can't push on a string.
That's a perfect analogy.
It is. The liquidity is there, the central banks have turned on the taps, but businesses, consumers, they don't have confidence, or they already have too much debt, so they aren't borrowing. The string is the credit demand, and you just can't force people to pull on it.
And that trapped liquidity, it has to go somewhere.
Exactly. It's the fuel for the U.S. bubble we need to talk about now.
Right. If the money can't get into the real economy, it floods into financial assets. This brings us right to the heart of it. The U.S. hype and liquidity bubble. Let's talk valuations, because these numbers they're genuinely shocking.
The most alarming indicator, by far, is the Shiller cyclically adjusted PE ratio, the KP ratio. For the S&P 500, it stands at a staggering 40.74.
Okay, for anyone listening who doesn't track this metric obsessively, let's put 40.74 in real historical perspective. Where does that number put us?
It puts us in extremely dangerous territory. I mean, the second PE ratio was only higher once before, at the absolute peak of the 2000 dot-com bubble when it hit 44.
Wow.
Just remember context. Before the 1929 market crash, it was only around 30. So a number like 40 isn't just high. It means investors are pricing in absolute perfection. They're ignoring economic cycles entirely.
Pricing in perfection. It means you're ignoring basic economic gravity like mean reversion. The idea that eventually profit margins have to come back down to the average.
That's exactly it. And the sources highlight these projections for the semiconductor sector for 2026. 50% profit growth and 40% margins. It's not a realistic expectation to bake into today's prices.
So any little thing could set it off.
Any tiny shock, a supply chain hiccup, a new tariff, some unexpected regulation. Chatham House argues it could trigger a massive, instantaneous repricing event.
And the risk isn't just the price, it's the market structure itself, the Magnificent Seven. This concentration risk it's overwhelming.
The market has never been this top-heavy, and this is where the scale of the numbers just becomes frightening. NVIDIA and Alphabet are projected to individually get close to or even exceed $5 trillion in market cap in 2026.
I just want to pause on that number. $5 trillion?
For one company?
Two companies.
Two companies, right? Potentially worth more than the entire stock market of Japan or Germany. It makes you realize how the entire global system depends on the success of just 2 or 3 business models.
And that concentration is tied directly to what the sources call the passive investing trap.
This is a really critical point for you, the listener, because it probably involves your retirement account.
Oh, absolutely. Trillions of dollars in U.S. retirement savings, your 401ks, your IRAs, they are all flowing passively into these cap-weighted index funds, ETFs.
And by definition,
those funds are forced to automatically buy more of the biggest, most expensive stocks, no matter what the valuation is. So this passive buying just inflates the bubble on the way up.
But if the trend reverses, that same passive mandated selling could become an accelerator for a collapse.
It's a feedback loop that's literally built into our financial plumbing.
And we have another classic end-of-cycle signal from the creative planning analysis. Bad market breadth. Why does market breadth matter so much?
It's basically a measure of the market's overall health. When breadth is bad, it means the index is going up, but only because a tiny handful of companies are doing all the work.
The rising tide is not lifting all boats.
Not even close. It's a few massive cruise ships creating a wake. The sources show nearly 200 S&P 500 companies had negative returns in 2025, and only 2 of the Mag 7 actually beat the index. When those few ships hit an iceberg, everything goes down.
That focus on the Magnificent Seven leads us right to the foundation of their value, the promise of AI. So let's shift to this AI spending reckoning, the CapEx wall.
This is the $500 billion question, literally. The tech valuations are only justified if AI delivers revolutionary productivity gains, like right now.
And the spending is enormous.
S&P 500 companies' AI capital expenditure, that's money on GPUs, data centers, all the hardware, is expected to blow past $500 billion in 2026.
A $500 billion bet on revenue that hasn't shown up yet. And the central question from Goldman Sachs and Sequoia is just blunt. Where is the revenue?
It's the ROI problem, the return on investment. That $500 billion in hardware needs hundreds of billions in software revenue to make any sense. And that revenue is, well, it's still missing in action, especially outside the tech sector itself.
So 2026 becomes this watershed year. It's a year that investor patience, which has been basically infinite so far, might finally run out.
If the big players, Microsoft, Meta, Google, if they can't show that AI is actually improving their bottom line, that CapEx cycle could just stop on a dime.
If they stop buying chips.
The order books for NVIDIA, AMD, TSMC, they instantly collapse. The bubble pops. And what's crucial here, as the Chatham House analysis notes, this isn't just a financial disaster. It would fundamentally undermine U.S. tech dominance against China. It's a geopolitical event.
So that's the fast-moving bubble. Let's talk about the second, quieter risk, the one moving at glacial speed. The commercial real estate, or CRE, silent collapse.
This one is insidious because it moves so slowly, people almost forget it's happening. The CRE market, particularly office space, is in a permanent structural decline because of remote work.
Right.
Office use in cities like San Francisco, Chicago, it's just stubbornly low. Those buildings aren't needed the way they were.
And 2026 is the critical year because
Yeah.
of this refinancing wave that's about to hit. That's the mechanism that turns a slow decline into a sudden crisis.
Exactly right. It's the maturity wall. You have this huge volume of commercial loans that were made when interest rates were basically zero, and now they're all coming due.
So they have to be refinanced at much higher rates.
Much higher. But since the value of the buildings has collapsed, the loans are now underwater, the debt is more than the property's worth, so banks are forced to take massive losses.
And the key question is, who holds all this debt? It's not the big Wall Street banks, is it?
And that's the unique vulnerability here. The sources confirm a huge proportion of these CRE loans are held by small and mid-sized regional banks.
So if property values keep falling,
It threatens a wave of regional bank failures that could be much larger and more disruptive than what we saw in 2023 because the exposure is spread so widely across the smaller banking system.
okay, so we've got these two systemic risks, the tech hype bubble and the slow motion CRE crash.
Mm.
But they're both sitting on top of an even more fundamental problem, the fiscal backdrop, the $38 trillion question.
The scale of the U.S. national debt is it's almost impossible to comprehend. It's on track to hit $38 trillion in 2026, pushing the debt to GDP ratio to around 121%.
And the deficits aren't getting smaller.
No, deficits are still high, and a big part of that is just the soaring interest expense needed to service the existing debt.
Okay, so if the economy slows, the Fed cuts rates. That should help. But government debt and inflation create this opposing force. This is where we hear the term bond vigilantes again, which is a phrase I feel like we haven't heard in years.
This is the core inflation-debt conflict. If inflation turns out to be stickier than the Fed hopes, maybe because of wage pressure or new tariffs, then the Fed just can't cut rates as much as the market wants.
And with so much debt being issued.
When the supply of debt is that high and inflation fears are lingering, market actors, the bond vigilantes, they demand much higher yields to buy all that government debt.
And higher government bond yields mean higher interest rates for everybody else.
Precisely. It crowds out private investment. It raises borrowing costs for corporations, for small businesses, and it leads directly to a spike in bankruptcies, even if the Fed is trying to be accommodative. It's the price of unchecked fiscal expansion.
The sources also point to some political risks that could make this worse, and we just want to report on those financial consequences impartially.
Right. The analysis points to the risk that certain fiscal policies, like tax cuts or new tariffs, could actually increase the deficit even more and add more inflationary pressure.
Which creates a vicious cycle.
A negative feedback loop. More deficits mean more debt, which means higher yields, which means higher interest costs, which means an even wider deficit. We're simply reporting that the sources see political action as a significant driver here.
So let's bring this all together. What does this mean for you, the listener, trying to navigate 2026? We've covered these two incredible tensions. You have the historically tight bubble in U.S. tech, that KPE ratio of 40.74, and you have it sitting right next to these slower, but just as systemic risks of CRE and this mountain of public debt.
The key takeaway, I think, is to understand the asymmetry and the divergence, that stable global growth you read about. It's a mirage. It's built on these fundamentally diverging systems, the concentrated U.S. engine versus the export-driven Chinese model.
And the central banks are at odds.
The monetary divergence. The Fed is easing while the PBOC is trapped. The policy levers are often fighting each other. Recognizing these interconnected risks is really the key to preparing for what could be a very unstable 2026.
And maybe the biggest tension we've covered today is that conflict between policy and reality. If the Federal Reserve is actively trying to cut rates to support the economy, but at the same time, massive government deficits are driving Treasury yields higher, which one of those forces wins?
And more importantly, what is the cost of that conflict? That fundamental clash between monetary policy and a fiscal reality. What does it cost the real economy, the average company, and the average worker? And that is the provocative thought we'll leave you with today.